Good day, everyone, and welcome back to First Bank Wealth Management's Market Commentary video series. My name is Todd, Executive Vice President and Managing Director of First Bank's Wealth Management Group. Well, the U.S. stock market has certainly been disquieting of late. The Dow has had 4 straight weeks of losses. The S&P has had 2 straight weeks of losses. However, despite the losses and increased volatility, the S&P is only 3% below its all-time high, which was reached on the last day of April. The cause for the down weeks? Trade tensions with the U.S. and China. As I'm sure you know, this month the U.S. raised tariffs from 10% to 25% on $200 billion of goods that the U.S. imports from China. Beijing countered and said, I see your $200 billion and I raise you $60 billion in tariffs on American goods. Not to be outdone, the U.S. countered their counter with the threat of $300 billion in new tariffs on China imports of children's clothing, toys, and cell phones. Does it seem like there's a bit too much testosterone in the air? This is shaping up to be the mother of all game theory contests. On one hand, you might think China has more to lose because the U.S. buys about $380 billion more from them than they buy from us. So a trade war hurts their economy more than ours. But on the other hand, the U.S. has a presidential election in 2020, and a strong U.S. economy and a strong U.S. stock market certainly helps President Trump's re-election chances. A prolonged trade war with China will negatively impact the U.S. economy by potentially reducing our annual GDP between 0.5% and 0.75%. This would also negatively impact the stock market. China's Xi Jinping does not have to worry about re-election, so theoretically, he can be more patient and a bit more Machiavellian because he has more time on his side. But make no mistake, trade wars are bad for both parties. A fair trade agreement would be very beneficial to both countries. We remain sanguine that a new trade agreement gets done, although it may take a while. The longer it takes, the more likely we continue to see high volatility and market pullbacks. If we don't get a deal by the end of the G20 summit next month in Japan, a stock market correction cannot be taken off the table. We still believe this market will go higher over time. We have tailwinds from deregulation and tax cuts. Jobs and wages are moving up. Corporate earnings and the overall economy are doing better than expected. Our advice, stay invested, be globally diversified, keep an allocation to bonds, and use any equity market declines as an opportunity to rebalance your portfolio. Stay close to your First Bank Wealth Management advisor, and we will guide you through the storms. Thanks for watching. See you next time.